Let me start with a quick confession. Every time mortgage rates drop, my phone lights up. Friends, family, random people I haven't talked to in years. Is now the time to buy? Are home prices about to crash? Should I wait or jump in before it's too late? And honestly, I get why everyone's confused. Because when rates plummet, it feels like the rules of the housing market suddenly change overnight. So let's slow this down and talk like real people, not headlines, not TikTok panic, not realtor hype. Just what's actually happening, why it matters, and how you can use this moment instead of getting played by it. The hook. Lower rates don't mean cheaper homes usually. Here's the part nobody likes hearing. When mortgage rates drop fast, home prices usually go up, not down. Yeah, I know. That sounds backwards, but I've watched this cycle play out over and over. Rates fall, right arrow buyers rush back in, right arrow competition heats up, right arrow sellers raise prices, right arrow affordability barely improves. So the question isn't, are rates lower? The real question is, what does everyone else do when rates drop? Because markets don't move on logic, they move on behavior. A quick real story. This is important. A few years back, I had a friend, solid job, good savings, not reckless, who waited forever to buy. He kept saying, prices are too high. I'll wait for rates to come down. Then rates dropped. Within months, the same houses he was watching were selling for $40,000, $60,000 more. Multiple offers, waived inspections, people losing their minds. He finally bought at a higher price with the same monthly payment he could have had earlier. That's the trap. Why falling mortgage rates push prices up? Let's keep this stupid simple. Most people don't shop for houses based on price. They shop based on monthly payment. If someone can afford $2,500 a month, lower rates suddenly mean they can afford a more expensive house. So when rates drop, buyers qualify for more demand jumps, inventory stays tight, sellers get confident, prices creep higher, the payment feels manageable, but the debt gets bigger. And that's how people end up house poor without realizing it. So, is this bad news or good news? Neither. It's just information. Lower rates are a tool, but like any tool, they can either build wealth or wreck you depending on how you use them. This moment rewards people who think long-term, not people chasing headlines. What this means, if you already own a home, you're probably in one of three situations. 1. You locked in a high rate. This is the obvious win. Refinancing could lower your payment or shorten your loan term. But listen carefully. Don't refinance just to save money and then stretch your loan back to 30 years again unless it actually helps your long-term plan. Lower payment plus same spending habits equals nothing changes. 2. You bought recently, ignore the noise. Home ownership is a long game. Short-term price swings don't matter if you're not selling. Focus on keeping your expenses low, building equity, avoiding lifestyle creep. 3. You're thinking of selling, lower rates, bring buyers back, but don't assume you're guaranteed a bidding war. Buyers are still price sensitive, and incomes haven't exploded. Price realistically. Greed kills deals. What this means, if you're thinking about buying this, is where people mess up. If rates are falling and you rush in because you're scared of missing out, you're playing defense, not offense. Here's how to play it smarter. 1. By the payment you can afford, not the bank's limit. Just because a lender approves you for $600,000 doesn't mean you should take it. Banks don't care if you're stressed every month. You should. 2. Assume prices will stay elevated. Don't buy hoping for a crash to save you. Buy because the numbers work today. If the deal only makes sense with perfect future conditions, it's not a good deal. 3. Think refinance, not FOMO. One of the smartest plays right now is buying a reasonable home and planning to refinance later instead of stretching for the biggest house now. You can change the rate later. You can't undo overpaying easily. The bigger wealth lesson most people miss. Here's the uncomfortable truth. Most people don't get rich from timing housing perfectly. They get rich from not over-leveraging themselves. The real wealth builders, by modestly keep housing costs low, invest the difference, let time do the heavy lifting. The loudest people online are usually the most overextended. Quiet consistency wins. What I'd personally do right now if I were buying today, Here's my mindset. Ignore hype-run conservative numbers. Assume no appreciation stress test. The payment leave room to breathe if the deal works, even if prices go nowhere. That's a green light. If it only works because rates might drop more or prices might explode, that's gambling. Final thought, this is the part to remember. Mortgage rates dropping isn't a gift. It's a shift in the game. Some people will use it to make smart, boring, wealth-building moves. Others will use it as permission to stretch, panic, and overpay. Don't confuse excitement with opportunity. Wealth isn't built by reacting faster than everyone else. It's built by thinking clearer when everyone else is emotional. And right now, the market is emotional. Stay calm. Stay boring. Stay rich. When people hear mortgage rates are dropping, their brain does this automatic thing. Lower rates equals cheaper homes. It feels logical. It just feels fair. And it feels like the market is finally helping regular people again. But housing doesn't move on. It moves on pressure. And pressure doesn't come from rates themselves. It comes from what people do when rates change, why this assumption exists, and why it's so dangerous. Most of us learned money backward. We were taught, lower interest is good, higher interest is bad. Therefore, lower mortgage rates must mean better deals. That logic works for credit cards, car loans, and student loans. Housing is different because housing is limited, emotional, and slow to adjust. You can't just make more houses overnight. And when rates fall, demand moves faster than supply ever can. That's where things break. What actually happens when rates drop? Let's walk through the chain reaction. No economics jargon, just reality. Mortgage rates drop. Suddenly, buyers who were priced out come back. Buyers who barely qualified now qualify easily. Investors start running numbers. Again, people who were awaiting feel validated. This all happens at once. But the number of homes for sale barely changes. And so now you have more buyers plus same supply equals competition. Competition doesn't lower prices, it pushes them up. That's why falling rates often lead to rising prices, even when the economy feels shaky. The monthly payment illusion. Here's the part nobody wants to admit. Most buyers don't buy homes based on price. They buy based on what the payment feels like. If someone says, this house is $520,000, most people freeze. But if you say, this house is $2,600 a month, and now they lean in. Lower mortgage rates make expensive homes feel affordable without actually making them cheaper. That's the illusion. A simple example, no math degree required. Let's say at 7.5% interest, a buyer can afford a $450,000 home at 6.0%. That same buyer can now afford a $500,000. Did their income go up? No. Did their savings increase? No. Did housing suddenly become cheaper? Did housing suddenly become cheaper? No. All that changed is how much debt they're allowed to carry. And when millions of buyers experience that at the same time, prices move fast. Why sellers love falling rates? Sellers don't think in charts. They think in leverage. When rates drop, more buyers show up to open houses, more offers hit the table, homes sit on the market for fewer days. That confidence matters. A seller who would have accepted $480,000 suddenly lists at $510,000, adjusts to see, and someone pays it. Not because the home is worth more, but because financing got easier. This is why affordability rarely improves. Here's the painful truth. Lower rates don't fix affordability problems. They rearrange them. Monthly payments might stabilize, but down payments get bigger, loan balances get heavier, property taxes rise with prices, insurance follows suit. So even though rates drop, the overall cost of ownership often stays stubbornly high. That's why people feel confused. Our rates are down, so why does this still feel impossible? Because prices already adjusted. The media makes this worse. Headlines love simple stories. Our rates drop, buyers win, but markets don't work on vibes. They work on incentives. Yes. When rates fall quickly, urgency replaces patience. People stop negotiating. They waive inspections. They ignore fundamentals. That's how bad deals get normalized. Why waiting for a perfect rate to backfires? A lot of people tell themselves, I'll buy when rates go lower. But here's the problem. The moment rates drop meaningfully, you're no longer competing with Tired sellers, few buyers you're competing with. Everyone who waited with you, investors who ran the numbers again. Buyers driven by fear of missing out. That's not the moment you gain leverage. That's the moment you lose it. The real question you should be asking instead of asking, are rates low? Ask, is competition rising or falling? Because competition, not rates, determines whether you get a deal. Low rates plus high competition equals bad pricing. High rates plus low competition equals negotiation power. That's the trade-off most people ignore. This is where smart buyers think differently. Smart buyers don't celebrate falling rates blindly. They ask, are homes sitting longer? Are sellers cutting prices? Are buyers desperate or patient? They know rates are just one variable, and often the best buying opportunities show up when rates are high and everyone else is scared, not when rates fall and optimism returns. The wealth building perspective, here's the bigger lesson hiding underneath all of this. Wealth isn't built by getting the lowest rate. It's built by buying the right asset at the right price. Rates can change. Prices stick. You can refinance a mortgage. You can't refinance a purchase price. That's why overpaying in a low-rate environment hurts more than buying carefully in a higher-rate one. Final reality check lower mortgage rates feel like relief, and emotionally they are. But financially they're a signal that competition is coming back. A signal that prices may stop falling or start rising. A signal that patience becomes harder but more valuable. If you understand this, you don't panic. You don't rush. You don't assume lower rates equal better deals. You stay grounded. Because in housing, the people who win aren't the ones chasing rate headlines. They're the ones who understand what happens after the headlines hit. Let me say this plainly. The housing market doesn't run on home prices. It runs on monthly payments. And once you see that, a lot of confusing behavior suddenly makes sense. Why people overpay, why bubbles form, and why so many homeowners feel stressed even though they did everything right. How the monthly payment became king. Most buyers don't walk into an open house asking, is this home priced fairly compared to historical income levels? They ask, what's the monthly payment? Can we afford this? Will the bank approve us? That shift didn't happen by accident. Mortgage lenders, real estate agents, and listing sites all frame housing around payments because payments feel manageable. A big price number is scary. A monthly number feels familiar, like rent. So instead of anchoring on total cost, people anchor on monthly comfort. And that's where the trap begins. Why lower rates quietly change buyer behavior when mortgage rates fall? Something subtle but powerful happens. The same house that felt too expensive last month now feels reasonable. Not because the price changed, but because the payment did. So buyers don't think, this is a lot of debt. They think, we can swing this. That mindset shift expands budgets without expanding income. And when millions of buyers do that at the same time, prices climb fast. A realistic scenario, you've seen this happen. Let's say a couple is comfortable paying $2,800 a month. At higher rates, that might mean smaller home, older neighborhood, fewer upgrades, then rates drop. Suddenly the lender says, you qualify for $100,000 more. Same payment, bigger house. Now the couple starts justifying. You will grow into it. Prices always go up. We don't want to be priced out forever. They didn't change their lifestyle. They changed their debt ceiling. That's not wealth building. That's leverage creep. Why this feels smart even when it isn't. Here's the uncomfortable part. Buying based on payment feels responsible. You're not being reckless. You're not missing bills. You're not living beyond what the bank says you can handle. But banks measure risk, not quality of life. They don't care if you stop investing, you feel trapped in your job. Every surprise expense stresses you out as long as the payment clears. The system is satisfied. You might not be, but the long-term cost people ignore. A slightly higher payment today doesn't feel scary. But over time, bigger loan equals more interest paid, higher price equals higher taxes, larger home equals higher maintenance, lifestyle inflation fills the rest. The payment you can afford to slowly eats flexibility. And flexibility is where wealth actually lives. Why this hits first-time buyers the hardest. First-time buyers are especially vulnerable to this mindset. They've spent years watching prices rise and hearing, buy now or you'll be locked out forever. So when rates drop and approval numbers jump, it feels like a once-in-a-lifetime chance. But stretching early locks you into higher fixed costs, less room for investing, more stress. During downturns, the house becomes a financial ceiling instead of foundation. The emotional side, nobody talks about. Buying a home is emotional. You picture holidays, family, stability, success, so when the payment works, it's easy to ignore the price. But emotions don't pay mortgages during layoffs, recessions, or health scares. That's when payment-based decisions show their cracks. The dangerous phrase, "we can afford it." Most financial mistakes don't start with recklessness. They start with "we can afford it." Affordability isn't the same as sustainability. Sustainable housing leaves room for job changes, investing, emergencies, life payment. Based buying often leaves no margin. What smart buyers do instead, smart buyers flip the script. They ask, what price makes sense for my income? What payment still allows me to invest? What happens if my income drops 20%? They don't maximize what the bank offers. They minimize regret. They understand a smaller home with breathing room beats a bigger home with anxiety. This is how wealth actually gets built. Here's the quiet advantage of not stretching. You invest consistently, you handle surprises calmly, you don't panic sell you. Stay employed by choice, not fear that freedom compounds faster than appreciation ever will. Most wealthy people didn't buy the biggest house they could afford. They bought one that left space. A final reality check: mortgage rates will go up. They will go down. That cycle never ends. But the decision to anchor your life around a payment instead of a price sticks for decades. If you remember one thing from this, you can refinance a rate. You cannot refinance a lifestyle built on too much debt. The market rewards people who think past the monthly number, and the sooner you stop shopping payments, the sooner housing starts working for you instead of against you. Most people think the biggest danger in housing is waiting too long. It's not. The real danger is stretching yourself so thin that one small life change knocks everything over. Over-leveraging doesn't feel reckless when you're doing it. That's what makes it dangerous. It usually sounds responsible. We got approved. The payment fits our budget. Prices always go up. None of those statements protect you when reality shifts. How over-leveraging actually happens: people don't wake up and decide to ruin their finances. It happens slowly. You accept a slightly higher payment, you drain more savings than planned, you tell yourself income will rise later, you cut investing it temporarily. Then a temporary becomes permanent. And now the house owns you. Why fear of missing out pushes bad decisions. When mortgage rates fall, fear gets louder. You hear, this is your last chance, of prices will run away again, or renting is throwing money away. That fear convinces people to buy homes that only work in perfect conditions. But wealth isn't built in perfect conditions. It's built by surviving imperfect ones. What over-leveraging costs you long-term: a stretched mortgage doesn't just affect your bank account. It affects job choices. You can't risk a move. Stress levels. Every expense feels heavy. Investments. Nothing left to invest. Relationships. Money tension never stays quiet. The opportunity cost is massive. You don't notice it right away, but you feel it every month. The people who win play defense first. The wealthiest homeowners aren't the boldest. They're the most boring. They buy below their max approval with cash reserves intact, with room for rate increases, taxes, and repairs. They assume something will go wrong eventually. And when it does, they're fine. Missing out is loud. Over-leveraging is quiet. Missing out hurts emotionally. Over-leveraging hurts financially. One fades. The other lingers for decades. If a deal only works because rates stay low, income rises fast, nothing unexpected happens, it's not a deal. The wealth rule most people ignore. Here's the rule that actually matters. Your home should support your life, not control it. If owning a house stops you from investing, forces you to live paycheck to paycheck, makes you afraid to change jobs, it's too expensive, no matter what the bank says. Final thought: fear tells you to rush. Wealth tells you to leave margin. The people who build real wealth aren't the ones who bought the biggest house at the lowest rate. They're the ones who stayed flexible when everyone else stretched. And flexibility, that's the real asset. Most people react to mortgage rates like they're an alarm. Rates drop, right arrow, do something. Rates rise, right arrow, freeze. That reaction is exactly how people end up making rushed, expensive decisions they live with for decades. Smart buyers don't react. They use rates. There's a huge difference. Why rates trigger emotional decisions? Mortgage rates feel personal. They directly affect monthly payments, approval amounts, how expensive life feels. So it creates urgency. This is my window. I can finally afford something. I'll miss out if I wait. That urgency pushes people to compromise on price, inspection, and long-term comfort, all for a lower rate. But rates are temporary. Decisions are permanent. The biggest mistake, buying the rate instead of the house. Here's a quiet truth. People don't buy homes in low-rate environments. They buy payments. They stretch on price because the payment looks manageable right now. But when you buy based on rate conditions, you're assuming rates won't change again. Your income will stay stable. Nothing unexpected will happen. That's not planning. That's hoping. How smart buyers flip the script instead of letting rates dictate timing. Smart buyers ask better questions. Does this home work at today's numbers? Would I still be comfortable if rates never drop again? Can I afford this without sacrificing investing? Or peace of mind? If the answer is no, they walk. Even if rates are great, they understand something most people don't. You can refinance a rate. You cannot refinance a bad purchase. The refinance mindset. This is key. One of the smartest long-term strategies is simple. Buy a home that works now, then refinance later if rates improve. This does two things. It prevents overpaying. It gives you optionality. Optionality is power. When you buy within your means, refinancing becomes a bonus, not a necessity. Why this strategy reduces risk. Buying conservatively with the option to refinance protects you from rate volatility, market swings, job changes, unexpected expenses. You're not trapped waiting for a rate cut to survive. If rates drop, great. If they don't, you're still fine. That's what smart looks like. What a conservative numbers actually mean. This isn't about fear. It's about realism. Conservative buyers use one income, not two stress test payments at higher rates. Budget for repairs, taxes, insurance. Leave cash untouched. After closing, they assume life will happen because it will. Why waiting for a perfect conditions? A backfires. Some people try to time everything perfectly. Lowest rate, lowest price, perfect house. That moment rarely exists. Markets move before headlines. By the time conditions look perfect, competition is already intense. Smart buyers don't wait for perfection. They wait for sustainability. The wealth gap is built on decisions like this. Here's the uncomfortable reality. Two people can buy homes at the same time and end up with completely different financial futures. One stretches because rates are low. The other buys modestly and invests the difference. Price, 10 years later. One is stressed but house rich, the other is flexible, invested and calm. Same market. Different mindset. Rates don't build wealth. Discipline does. Rates are a lever. Discipline is the engine. Lower rates only help if you don't inflate your lifestyle, you don't chase max approval, you don't confuse excitement with opportunity. Without discipline, low rates just magnify bad decisions. What I'd personally do and why, if I were buying right now, my rules would be simple. Ignore rate hype by below my max comfort, assume no appreciation, leave room to invest, treat refinancing as upside. Not strategy. That approach isn't flashy, but it works. The calm advantage when you're not overextended. You negotiate better, you sleep better, you invest consistently, you make decisions. Slowly calm people make money. Panicked people make mistakes. Final thought. This is the one that matters. Mortgage rates are just one input. They are not a signal to rush. They are not a guarantee. They are not a shortcut to wealth. They're a tool, and tools only help if you know how to use them. Smart buyers don't chase rates. They build margin. Because in the long run, margin beats timing every single time. Every single time.